All right, my fellow investors, buckle up because today we re-tearing into my personal portfolio, celebrating some wins, and more importantly, plotting our next strategic moves in what I can only describe as a truly perplexing market. If you've been following me, I am not one to shy away from transparency, especially when it comes to the numbers that dictate our financial futures. Today, I've got some juicy updates, I've taken some significant profits, and I am on the hunt for new opportunities, specifically eyeing a few beaten down gems that I believe are poised for a serious comeback. First things first, SoFi, my conviction here runs deep, and frankly, when Anthony Noto, the CEO himself, is buying leaps that, as a signal I don't ignore, my thought process was twofold. If he sees that much upside, maybe I should be considering similar leveraged plays, and at the very least I should be accumulating more shares. So yes, I added to my SoFi position today. Call it following the smart money, call it conviction, whatever it is, I believe in the long-term vision and execution here. Now for the big news, I've actually taken some profits off the table from two of my absolute superstars, Micron and AMD. Let's start with Micron. This has been an absolutely phenomenal ride. When I first bought into Micron over a year ago, my thesis was clear: HBM, or high bandwidth memory, was not a commodity. For years, memory chips were treated like a generic component subject to brutal cyclicality and razor thin margins, but HBM, especially with the explosion of AI and the insane demand from hyperscalers and AI chip designers like NVIDIA, changed everything. Suddenly, you had a specialized high-performance, high-margin product that only a few players like Micron could reliably produce. This created a supply-demand imbalance that was destined to drive prices and, crucially, margins sky high. Micron's journey since then has been incredible. It became a trillion-dollar company. In my portfolio, a 10 times return on my initial investment. This kind of gain is rare, and while I am always one to let my winners run, I also believe in prudent risk management and locking in gains. So today, I sold off roughly 50% of my remaining Micron position. Why? Because sometimes you just have to look at those returns and be happy. I am extremely happy with the returns. Could it go higher? Absolutely. And the 50% I still hold will benefit from that upside. But there is a point where the mental energy expended on will they phase in. Will hyperscalers increase or decrease capex? Will software innovations suddenly make memory cheaper or reduce demand? Space starts to outweigh the potential upside. I want to be relaxed with my investments, not constantly worrying about the intricate dance of the semiconductor cycle. Taking profits allows me to reallocate that capital into other promising areas, or simply hold it in cash, reducing my overall risk profile. The HBM story is still compelling, no doubt. The phenomenon of decreasing cost leading to exponential demand. We've seen it with tokens, we're seeing it with memory. As prices come down, demand often increases by more than double. This is why I don't believe demand for memory will decrease in the next few years. AI applications will only proliferate, requiring ever more memory. However, what will come down inevitably are the margins. As more capacity comes online and competition intensifies, those insane margins we're currently seeing will peak. Micron is actively working on custom HBM, which is great, but the underlying dynamic of memory becoming less of a commodity doesn't mean it escapes the laws of economics entirely. It is a fantastic company, but my risk appetite for that particular cyclical exposure after such a run has shifted. Similarly, I trimmed my AMD position, taking around 56% of profits. AMD is now trading at a robust $53 per share, and like Micron, it's been a fantastic performer. My remaining exposure will capture any further upside, but again, celebrating and securing profits is a key part of my strategy. Now, let us talk about the broader market landscape because it is truly fascinating what is happening out there. Despite all the no deal chatter and the market's seemingly schizophrenic behavior, we're seeing a clear divergence. The usual suspects names like Micron, up nearly 20% today, Qualcomm up 6.5%, Texas Instruments 5%, GE 3.8%, and even SanDisk 7.5%, making it a $235 billion company are soaring. But then you look at NVIDIA, the very company enabling this entire AI ecosystem, and it was down 0.22% today. Some might argue NVIDIA is a $5.2 trillion company. It can go up every single day. Fair enough, but it is not like it is trading at 50 times sales or earnings, not even close. And Micron, a $1 trillion company, just jumped 19% in a single day. The market's current narrative seems to selectively reward certain components of the AI boom while temporarily neglecting others. This brings me to a crucial point about what hasn't been participating in this momentum-driven frenzy. I've been discussing names like Shopify, Axon, and Reddit. For a while now, these are companies whose businesses are performing exceptionally well, yet their stock prices have been battered year to date. Axon is down 31.5%, Reddit 41.4%, and Shopify 34.5%. Compare that to the SP 500 up 9.1%, and the QQQ up 17%. Even Nvidia, while having an incredible multi-year run, is only up 14% year to date, barely keeping pace with the broad tech index. Meanwhile, other tech giants like Microsoft are down 12.1%, and Meta is down 6.2% year to date. This divergence is stark. The market is currently rewarding specific segments, particularly semiconductors and certain cloud players, while indiscriminately punishing others. Look at the year-to-date performance in semiconductors. Beyond Nvidia, Intel is up a staggering 204%, Micron 138%, AMD 109%. Even the neoclouds fey companies like Nebius 138.8%, Whitefiber 79.4%, Applied Digital 63.2%, and others fey are significantly outperforming the broader indices and even some of the mega-cap tech and Nvidia itself. This tells me that the market is chasing specific, narrow narratives. My concern is that many investors seeing this disparity are now rushing to chase these high-flying names. Fearing they've missed out, I see the sentiment. My Nvidia fey, Meta fey, Microsoft isn't T going up. I need to pile into what is hot. This is precisely the kind of emotional momentum-driven investing that leads to trouble. Conversely, nobody seems interested in the names that are currently being beaten down. Nobody wants to look at an Axon, a Reddit, or a Shopify right now, despite their underlying business strength. While some might argue that following momentum makes sense in the short term, I've made that mistake before. Yes, you adapt, you learn, but we also need to acknowledge that many of these software names, while down significantly from their 52-week highs or all-time highs, were also trading at incredibly high multiples during the pandemic, fueled tech boom. A 30%, 40%, or even 50% drop doesn't automatically make them a bargain. However, what it does do is shift them from expensive to less expensive, and in some cases to genuinely undervalued. The market's current disdain for many software names isn't a SaaS apocalypse, though. That is a cool name. It stems from uncertainty surrounding their business models in the age of AI. The concern is that traditional software as a service models, which enjoyed incredibly high margins, might be disrupted by AI, potentially leading to lower future margins. The market, in its characteristic fashion, shoots first and asks questions later. But for long-term, patient investors, this presents a phenomenal opportunity to acquire shares in exceptional companies that were once prohibitively expensive. So, with all that context, I am actively looking at Axon, Reddit, and Shopify before I dive into each. A quick reminder, if you are enjoying this content, please smash those like and subscribe buttons. It genuinely helps the channel, and for deeper dives and all the data points I am referencing, check out Fiscal AI, my fantastic partner. Link in the description for a 15% discount and 2 weeks free for new users. Let us start with Axon. This company has almost doubled over the past 3 years, yet it is down 48.1% over the past year and 31.3% year. To date, is the business struggling? Absolutely not. Axon was, and to some extent still is, an expensive stock, but it is a rapidly growing business. Its connected devices revenue is up 32.8% year over year, and software and services, which I expect to become an even larger, higher margin component of their revenue, is up nearly 35%. Future contracted bookings are soaring, up 44.4% to $14.3 billion, and net revenue retention is a robust 125%. Revenue has increased by 34% over the last 12 months and is projected to grow over 30% for the next several fiscal years. This is a fast-growing company with a strong competitive moat bordering on a monopoly in its niche. My DCF analysis, even on a base case, suggests it's less expensive. Now, the bull case indicates a 41% upside, while the base case sees it fairly valued around $300, implying a 22.6% downside from current levels. It is not cheap in the traditional sense, but it is less expensive and offers a compelling long-term growth story. Moving on to Reddit, down 40.2% year to date, but still up 38.3% over the past 12 months. This $27.85 billion company is growing incredibly fast. Despite strong quarterly results, the stock has been hammered largely due to the market's current preference for anything with a direct semiconductor or memory play. But Reddit is business, fueled by a 46.5% expected revenue growth this fiscal year, followed by over 25% growth in subsequent years, is thriving. Free cash flow is expected to explode, growing 76.6% this year to reach $2.1 billion by fiscal year 2028. Reddit's strength lies not just in advertising, but crucially, in its licensing deals for its vast human-generated data, which is invaluable for AI companies. While Meta might attempt copycat forums, Reddit's authentic, community-driven content remains a unique asset. My probability-weighted DCF suggests a fair value closer to $150 per share. offering a small upside from current levels but with a significant bull case upside of 56.9%. Even the bear case shows continued growth, just not at a pace to justify higher valuations. The key here is the underlying growth and the strategic value of its data. And finally, Shopify, the largest of the three at $137 billion. While it is actually down 16.9% over the past 5 years, a period heavily distorted by the pandemic boom and bust, it is still up 73.8% over 3 years. More recently, it is down 3.5% over 12 months and 34.5% year. To date, like Axon, Shopify is cheap, nor is it deeply undervalued based on my last analysis, which suggested it would be a strong buy closer to $80. However, it is significantly less expensive than it was. This is a fundamentally excellent company with world-class management AI. In my view, is an accelerant for Shopify, making its platform even more powerful for merchants and users. Its ability to rapidly integrate new technologies and features is a massive competitive advantage. Look at its GMV growth, crossing $100 billion for the first time last quarter, accelerating to 34.7% year-over-year, the total addressable market for Shopify, encompassing payments, e-commerce solutions, and advertising, is enormous. Could Shopify become a $500 billion company? Absolutely, given its trajectory and track record. With Shopify, I don't have to concern myself with the semiconductor cycle or hyperscaler capex. It is exposed to recessionary risks, of course, but so is nearly every other company. So, where am I leaning for my next big move? I am personally trending towards Axon. My portfolio currently has exposure to social media and advertising with Meta and e-commerce. My existing Shopify stake, though I may add more, Axon offers diversification into a sector I don't currently own, with a unique, high-growth, near-monopoly business model. It is a $30 billion company growing very quickly, and while not the cheapest, I believe a repricing is due as the market reevaluates its consistent growth and strong fundamentals. After Axon, it is a 50-50th split between Reddit and Shopify, perhaps leaning slightly towards Shopify 51%. Over Reddit, 49% due to my deeper confidence in Shopify's management team and long-term vision, even though Reddit is currently the cheapest of the three based on my DCF models. Lastly, a quick mention of Zscaler. They just reported a double beat, good numbers, good growth. Yet the stock might be down even more than the 15% it was when I initially recorded this. Why? Like guidance? That is often all it takes in this environment. Even slight conservative projections can trigger a disproportionately harsh market reaction. Zscaler is still down year to date. Despite a recent bounce from its bottom, it simply reinforces the message. The market is currently incredibly unforgiving of anything less than perfection in certain sectors. In conclusion, this market is a lesson in selectivity and patience. While some names soar to incredible heights, others equally strong in terms of underlying business performance are being overlooked or unfairly punished. My strategy involves locking in gains from my high flyers and patiently accumulating shares in these excellent yet currently unloved companies. Let me know in the comments below what you've been doing with your high-flying names and if you are looking at any beaten down opportunities yourself. Your insights are always valuable. See you all in the next one. Bye-bye.